calculate that as an annual return versus a one-time lump sum ROI. Because that will dramatically increase your returns no matter what you do. And you could do this, if you could do this 4 times a year, season it for 2 months, sell it to us, season it, sell it over and over again, that 10 grand on 40 multiplies.
And yes, we're more than happy to buy notes from you all through the year, any day.
Hey everyone, Dave Putz here from JKP Holdings, alongside me, as always, Mr. Nathan Turner. How are you?
Very good, very good. Trying to stay warm.
Oh my God. Apologize for that. I hit a button. So I wanted to make sure that we connect for a few minutes. Let us, people who don't know who we are, kind of get to figure out what's going on here. I'm Dave Putz. I've run JKP Holdings for about 10 years plus. I've been buying notes, mortgage real estate backed notes for that many years. And I've been primarily buying bank originated, but we're working into this idea of seller finance notes. We bought a few of them, but we're learning a little bit more about them. And that's where I'm at. Nathan, care to share about yourself?
So I'm Nathan Turner. I started in notes in about 2008, and I was creating notes like a lot of you guys do. And it was in Ohio. So in Ohio, it's a land contract. We were making all these land contracts, and one of my biggest stumbling blocks is like, okay, how do we cash out of these? How do I make money on what I've now created? And took some classes and started meeting some people and learned all about notes and this whole secondary market that I had no idea existed before. And now it's kind of come full circle, it feels like, where now Dave and I are here. We want to help those who are doing what I used to do about creating notes. There is an outlet, and there is a way where you can cash out of these. You can go out and make some more money, and we are more than happy to buy your notes. So we're going to get into all of that stuff today, but that's just kind of a real brief introduction.
Absolutely. We have a lot of people here who don't know who we are. A lot of people are really interested in this topic. And what we found is a huge bridge between the world of note buyers and those who are originating notes, the seller finance, owner finance origination world, and us. It's almost like two different bubbles. And what you're going to find out today is that our connection between what you guys do and what we do can be seamless, where it just flies, which is awesome. So I want to make sure you guys tune in, ask questions. I got a few things going on here to kind of track things. We're on LinkedIn, we're on Facebook. Hopefully everyone can see us and hear us and all that good stuff. If you have a problem, make a comment in the box and we'll go from there. But we wanted to start up with you guys. We do have some guests, which we'll bring on in a second, but we wanted to just kind of introduce what we do and some of the first things what we want to talk about today.
Yeah, so we, like
this
I said,
new to us.
It's a big world and it's a big leap. Like I say, I started out with creating notes, which is great, and I love creating notes. I still do it today. A lot of seller finance notes. Mainly, what I buy, and Dave as well, is mortgage notes. So people will go and get a mortgage with a bank, with whoever, Wells Fargo, Chase, Bank of America, you name it, whatever bank. The bank will then sell that note. And there's all kinds of reasons why they sell that. But the short story is we will buy those notes. We are not banks. We act as banks do in some cases. But we don't actually own the property. We just own the mortgage attached to the property, or the note attached to the property. And so we collect payments in that way. So that's a very, very brief introduction of what we do. What else you got, Dave?
Yeah. So one of the things we wanted to first share with you guys is that we get the concept of mortgage and note, and what you guys are doing, we get, right? But what we want to share with you guys is why would you sell a note? You know, and what do you need to provide to us, and what you don't need to provide to us to make the numbers work.
Yeah.
Right. So one of the things we want to share with you guys is that you guys make huge profit when you create that note. Huge profit. You create a note that you're into a deal for 40 grand, you create $100,000 note. Oh my gosh, it is awesome. Out of thin air, you created money. And we have some great people who are going to be joining us today who are doing just that, as well as those who are doing it on a larger scale. They'll be in the chat, I'm sure. So when you create that note, what you don't realize that you can cash out everything you're into it for, plus more, which is awesome.
Mm-hmm. That's what we do. We go around, we buy the loans. Like I said, I do some origination still, and I enjoy doing that. But my main business is buying already originated notes. So somebody else created that note. I'm just buying it as an income stream. That's my core business. So hopefully you can see already how our two businesses really come together.
So we have some cheat sheet here to kind of go down our checklist and make sure we include everything for you guys.
Yeah.
So when you create that note and you create this money out of thin air, do you know you can sell that note to us, the collateral, and just create another note? Amazingly enough, I'm finding a lot of you guys don't know that we exist or where to turn to sell that note. And today we're going to talk about what you can do to turn to sell the note to any of us and what details you need. You can take this money and go buy another property with it. You can do anything you want with it. The one caveat is some of you guys have some assets that are non-performing. Oddly enough, we buy them too. Call them crazy, but we buy them too, right? So
yeah, both Dave and I started out really, after the whole recession happened. So we both started out buying non-performing notes as our main business, where people are not making payments, living in the house. That's what we started buying in 2010. And that's been a major part of our business for the last 10, 12 years.
Yeah.
So if you've got one of those problem notes, or let's say they're just not paying regular and they're just kind of a thorn in your side, we buy those too. We call those scratch and dent. So we'll buy the scratch and dents, we buy the non-performers, we buy the performers, we buy pretty much anything. So hit us up.
yeah. So when you're looking at buying this kind of stuff, there are two different worlds you play in. We have the seasoned note and buying at the table, at the closing table. You can sell either one of them. Mm-hmm. Understand the fact that if it has some seasoning, which just refers to a time period of proven payments, we can buy it for actually a bit more money, right, than if it's brand new. The risk level is higher. You can also sell part of the loan payments in the first 5 years, or you can collect the whole thing and sell the whole note off and do what you want with it. Yeah. One of the caveats we've seen recently, and we actually have two people who are professionals in their space as well, is creating what they call an 80-20 loan. We have 80% on first, 20% in the second, and you can sell the first off and keep the second for payments and sell the 80% of whatever loan you're creating for huge profits for you guys.
And then you still got that 20% second that you can collect some money off that as well. So you still have some cash flow, but then you've got that big chunk that you can go back out and do whatever you're going to do, or whatever personal thing you've got. Maybe you're sending somebody off to college, or maybe you're, renovating your own kitchen, or, whatever it is you've got money needs for. We're here to help fill that gap.
Yeah, absolutely. So I'm just going to bring up some information here. What we do have today is a few special guests who are not going to be on video, and then two guests who will actually be on video. If you're familiar with note creation, subject twos, or any of that kind of world, you've probably used an underwriter. Well, we have Max from Call the Underwriter on. He'll be off video, but he's going to be discussing things or answering questions we need to go to him. We also have Sohal, who runs Home Key Servicing. Sohal is a service provider who will act like a landlord for rental properties, but for note space. We're going to get into why a servicer is key for us, as well as for you guys as we go along.
And Sohal that's one service company. There's a bunch out there. We happen to have Sohal here. He can answer all kinds of questions. He'd be a great resource for you. If you move your services over to him, fantastic. That's good for him, good for us. And we'll talk about why that's good for us as well. We'll get into that.
Awesome. So let me switch over here. We should be good. We have some special guests on right now. Let me just make sure we got going on. We have two guests with us right now that we are really excited about, right? We have Justin and Melissa. Hopefully you guys are there and we all have her unmuted. So what we want to talk about today with you guys is this idea of you guys create notes and create dollars out of thin air, which I think is awesome. Oh, Justin, you're still muted. Melissa, can you share a little bit about how you got started in this idea of creating notes?
Okay, so please forgive me because some of the things that you are going to see are probably going to make you cringe, like the fact that I use apartments.com.
That's okay.
Definitely open to doing more better, as one of my real estate associates say. I've only been in this market for about 2.5 years. So it's been a learning game, right? It's definitely been a learning curve. My first deal was kind of just dropped in my lap, and I feel like God says, okay, you're done doing wholesaling. You're smarter than this. This is what I want you to do, and it just really, after learning this strategy, I was able to get out of the rat race and create millions of dollars in like 18 months. So it was life-changing for me very fast. I do specialize mostly on getting subject twos and then doing an owner finance with those subject twos.
Mm-hmm.
And I get 20% down and I create a great monthly spread for the most part. And yeah, everybody pays through apartments.com and it's a good life. However, I do often find myself cash poor, right? So I'm like, now I've gotten a hotel that I'm looking at and I've created all of these millions in notes. And I wouldn't mind cashing some of them out so I could get some cash to reinvest into this hotel that I'm looking at. So hopefully learning all of this by the end of this session, I'll be able to do that.
Yeah, awesome.
We may have to spread this out into a couple of webinars because there's a lot of information, but you're in the right place. This is great.
And we want to remind you guys, if you guys do catch this video in your middle of it, this will be on YouTube, will be on the Facebook page, be on our website. But yeah, YouTube channel, all the good stuff is there. Just look up JKP Holdings on YouTube and you'll find this video. So Justin, can you share a little about your background? How did you get involved with notes?
Very, very similar way. I started off wholesaling and I just really didn't like it. I was cold calling and, it was like offering these 50% deals or 50% for cash. And I just didn't like it. And then I kind of discovered the more creative route that you could take and just making win-wins for owners and, for buyers and sellers, making win-wins for us. I just try to make as many, it seemed like I could help more people that way. And help them faster. There was, I didn't have to raise as much capital, and a lot of times when I did raise the capital, I was able to, very, very similar to what Melissa was saying, buying subject to, and then if I had to come out of pocket any cash, I just turn around and get that cash back from an owner finance buyer. A lot of times, but sometimes, we've flipped a couple of houses that we just, that we couldn't find buyers for, and we just ended up owner financing them. And then, we were like, well, we can sell it. We've heard that you can sell notes. So, eventually, and I was, earlier this week, I actually sold my first note. So I've been through the process. But as soon as I opened up that can of worms, it was like, holy cow, there's so much more to this than I even knew.
Yeah. And you know what? I went through the exact same thing. I started creating these notes in 2008 in kind of all over Midwest, Ohio, Indiana, Michigan. And it was like, okay, there's got to be a way to cash out of these. And I'd heard rumors, I'd heard these stories about people that buy notes. And I went to a training seminar in 2009, and it just blew my mind. Like, all this huge secondary market that I didn't know existed. I went to a conference later that year down in Louisiana, and everybody's, talking about this thing that I just barely learned about. And yeah, it's real, and it's a very vibrant market. We'll say.
Yeah, my first one of my first deals, I actually traded equity in two houses for an owner finance house on the back end.
Yeah.
And so I had all this equity sitting there that I ended up selling and making all my money in the front end because I sold the other 2 houses.
Right.
But then I still had this other one sitting there, and I was like, well, that's all my money that's tied up still sitting there.
Yeah.
And that ended up being the one that I finally sold. And I was like, oh, well, that wasn't as hard as I thought it was going to be.
Yeah.
But there was just some intricacies that I had to learn and kind of get punched in the mouth and keep on rolling with.
Okay. Awesome.
So we want to get into a little bit more of the details of this stuff to make sure that those watching, you guys as well, what we're talking about here. So what people get interchange words a lot of times, right? So there's this thing called land contract, contract for deed. We also have a lease option. We also have, a deed of trust. All these different words that mean different things, but more generally mean the same thing, right? If I say, listen, is it a mortgage or land contract? You may say, why does it matter? Well, in legal sides, if a loan goes not performing, that does play a role. Certain states don't allow land contracts. You talk to people in Texas, they say, what are you talking about? Right?
I have no idea what a land contract is.
Yeah. You talk to
Contract
people
for
in
deed.
Ohio, Indiana, it's all over the place there. Michigan, right?
If you go to
So-
Louisiana, it's called a bond for deed. If you go one of the Carolinas, I think it calls it an agreement for deed. They're all basically the same thing. For our purposes, we kind of lump them together and call it contract for deed or CFD.
Yep. And we didn't know the difference. We would ask you guys to let us know what it is, if it's a mortgage or not. Just make sure you tell us what it is, because we have to price it differently. And certain states are actually discouraging land contracts with the judges. So, and certain situations where the land contract can't be foreclosed on or can't be evicted, you actually have to do a foreclosure, depending on the numbers.
And that doesn't necessarily mean it's a dead deal. It just means we just need to know what it is up front, so we know what we're going to get into here. If we need to convert that over to a mortgage at some point or something else, but we have options, we have things we can do. We just need to know what it is.
Cool.
Getting started.
You lost Melissa for a half a second.
Lost Melissa. Whoops. Hopefully she can jump back on.
We'll switch over.
So when you guys were talking about that, I didn't even realize that we could sell a lease option the same way we would sell a regular mortgage note. Because I do have lease options, but we like to take we like to see our lease options as the dating our tenant before we move them into owner finance.
Yeah.
And it actually works out really well for us. It's, we get to capture, all the tax benefits of being a landlord originally, and then we switch over into an owner finance deal. But I didn't, my concern was always, well, dang, if it's a lease option, I can't cash out of it because I can't sell it because I don't have, they have the option.
Yeah. Yeah. So short answer is we'll buy lease options. With a lease option, it's a little bit more particular, depending on the terms of the contract. They're all different, lease options are written differently. So we just need to read through the agreement and understand what's in there. But short answer, we'll buy lease options as well. We're probably going to do the same thing and flip it over to either a land contract for deed, whatever you want to call it, or to a deed of trust or a mortgage, a note. We'll probably convert it to something else sometime in the future. But short answer, we'll buy that.
Interesting. Okay.
We had a question here too. Kevin.
Yeah, Kevin asked, he does private lending for
question.
12 months or less. Is there any advantage of selling short-term notes and are marketable? If a note is 12 months, 5 months, 30 years, 20 years, it's a math equation, right? So anything you want to ask, feel free to put in the chat as well. But we can price it. You may get a significant discount, you may not. We run everything through our model and we figure these kind of things out, right? Is it marketable? Absolutely. The world of notes is really buying it as the numbers, right? We base our deals on numbers. Where we're going to get into, you guys base on dollars. And we talked to Justin earlier before we went on, and that idea of basing on dollars may make sense in some worlds, but we're going to show you why it makes sense to do it based on returns better. So the other question we have it was, can you convert a note a land contract into a deed of trust? Absolutely.
Yep.
It's done very regularly. We have Max on the audio, he can tell you about that in a short while, but if you need to, you can definitely convert that over. Call the underwriter, go to their website and you can convert any land contract over to a note. So,
And like even Justin, you're saying you need to go to a lease option and then convert them over. You don't need to. I mean, that's fine. And if you want to date them for a little while before you make it permanent, I get that. But you don't have to. You could just start off with a deed of trust, a mortgage, whatever it is in that state.
Is it as valuable that way? Is the note as valuable being a lease option over being a owner finance? Does that affect the value of that deal?
So probably in order of value, the lease option is probably going to be on the bottom of that. Again, not to say that it's not valuable, but I'm probably going to pay more for a deed of trust than I am for a lease option.
Okay.
Getting feedback. Is that me?
yeah, I'm not sure who that was, but Melissa's back. Welcome back.
Hey, Melissa. Glad to be back.
Struggling over here. It's pretty much the story of my life. Quick question about the lease option though. Okay, so let's say that we did a lease option with someone and we met you guys and you're like, okay, we'll pay more for deeds of trust and not so much for lease options. Could we go back to that lease option buyer and redo the deal, like start a DOT?
Yep.
Absolutely.
And then sell it to you. Okay.
Absolutely.
Definitely. Yeah.
We would recommend.
Yeah, so kind of piggybacking off of what she's saying, is a lot of times what we do is when we advertise for the owner finance buyers, we have our lease option is say 5% down, and then our owner finance would be 10 to 15% down.
Mhm.
Would be kind of like what she's saying. If I took the 5% down and then in a year say, okay, you still got on-time payments, let's go ahead and convert it without you coming with the rest of the down payment, would that be something that would, and then immediately turn around and call you guys and say, hey, I've got this owner finance situation or deal for sale? I guess it'd be a note at that point. Would that affect anything?
So a couple of things. Dave, I'll get you in a sec. But so 10% down is better than 5% down for sure.
Of course.
You've got now 12 months of pay history though as well. That's
right.
Also something. So that
even though that's technically rental payments.
They're making regular
it's
payments.
A seasoning.
Right.
Right. And
so even rental payments are seasoning.
Yeah. And you may say, listen, I have 2 payments, but then you say, listen, I have 12 months of rental payments I can prove. That's more attractive than some brand new person, right? Think about if you're buying a rental property, if you're going to buy a performing rental, right? What do you do with the situation where if property is already rented out for a year, you feel good about that renter.
Yeah.
Or if it's brand new rental, buy a performing rental and they're brand new, it's not so attractive.
So the 12 months kind of offsets that a bit, the 5% down.
Oh, okay. That was going to be my next question, because a lot of times we wait for them to come up with the rest of the down payment to convert them over, but it sounds like we'd be just fine just moving them over into an owner finance as it is.
Yeah, and so maybe that's the next thing we should get into, David. We've had another question about that, about what kind of terms we're looking for, that kind of thing. Maybe that's the next step here.
Yep. Go down our checklist here. So go ahead and start off with that.
Yeah. Oh, you want me to? Sorry.
Yeah, go ahead. Sorry.
Okay. So we're looking at a few different things. When we're looking at a note, down payment is the first thing. So the bigger the down payment, the better. It shows that person's got skin in the game, and you guys all know this. This is what you do. But that bigger the down payment, the more skin in the game, the safer it is for somebody to take that on and have confidence that they're going to continue to make payments long term. So that's number one. Down payment, bigger the better. I would say as a general rule, I would go 10%. Dave, you looking at anything different, or is that about right?
You know, it's weird, right? With this seller finance world, with bank originated notes, this never was a problem, was never an issue. So it did now the world is, I'm more worried about LTV now because of what's going on out there than actually down payment per se. So on a $5,000, I would think more percentage wise. So if that note is $5,000, but it's a $50,000 note versus a $100,000 note, to me, that percentage is big, but I can figure out the percentage why. So down payment will allow me to figure out the percentage that was down made. For me, that's more attractive than a dollar amount.
Yeah, good point. Yeah,
But
good
before
point.
we get to our list, I wanted
Yeah.
to make sure that you guys have some more general knowledge before we dive into it. And we're gonna have a form, I'll put it in the chat box here for you guys, that will allow you to get the full list of items that we want. Any note buyer would want, actually. So one thing you have to figure out is, are you a borrower or a lender? And what I mean by that is, a lot of you guys out there are subject to buyers, where you bought a property subject to, and you're technically a borrower to the other one, but then you're a lender to the new owner. And there's some Dodd-Frank rules behind what you're doing to make sure it stays legal. We're not going to get too deep into that right now, but if there's a question about that, we can kind of hit on things. But we got to make sure that if you're a borrower and a lender, we need to make sure if we're buying that second lien that's created, or that CFD, whatever you're creating, is able to pay off the first, and the contract shows the fact that we can do that. In addition to that, making sure you let the borrower know that the first lien is still there. You need to let the borrower know that the subject to lien is there, or because there's subject to situations, if you have questions, we have Max on that can explain a little bit more about that. But you need to make sure your borrowers know that there's the first lien on there. Some other things are the amortization UPB. We're going to get into what that means, but understand there's a UPB, unpaid principal balance, as the note goes down, and that should stay amortization wise. And that relates to a payment, right? When you make a payment that's $742.36, if they pay $740, that wasn't a full payment. It sounds foolish, but it affects the way the balloon on the end of the payment is. Even that change, because if you take 10 cents and multiply it by 360 payments, there's a balloon at the end of it. And that will change everything out. And if it gets contested in foreclosure, we buy it and start defaulting, that all come back into play.
So I have a quick question.
Sure.
If I can go back to the subject to question, the subject to discussion. And correct me if I'm wrong, but if I have an underlying mortgage and then I have a wrap note on it, and you buy that second lien note, it would wipe out the first and make you the first lien holder, correct?
Yes.
Yeah.
Okay, and it has to happen that way, right?
Does it
Yes.
have to? Yeah, I guess it
Well,
does.
I mean, it doesn't have to. We prefer to. Let's put it
Yeah.
that way,
Yeah.
right? Because I'm gonna get another thing is, if you're buying a first lien or buying a second lien, the pricing changes. Just like seasoning. So the first lien is not as risky as the second, which means I'm gonna buy that second at a much deeper discount.
Okay, so let's say I have an underlying lien that's dang near the same as the if I, because I'll buy subject to houses that have no equity in them, and then I'll wrap them. You know, obviously I can't sell just that second lien,
You
right?
You can actually.
I love it. I love it. Yes. So
Okay,
you
I
can tell
guess
me
I'm
the
confused
second
if
lien.
I sell that second lien.
Let's use real numbers here. You bought a
Okay.
subject to property for 40 grand, you're into it, you rewrote a note on that property, say $100,000. So you have total debt of 140,000. If I sit there and give you, say, 80 grand for it, you can take 40 of that grand, pay off the first, which I would want, and then you get 40 grand in your pocket and you walk away. And then I'm in first position now.
Right. And if
That's it.
if I don't pay off that first lien, wouldn't that first lien get paid off at closing?
So there's no closing here.
Right.
We're not doing a title closing here at all. This is not a property sale. This is a note sale.
Just notes.
Okay.
I love it. I love this.
And is there any legality there that I should be, concerned with, with in a situation like that? Because if that first note gets called, I mean, I'm technically I'm out of the woodworks there. Why would I pay off that lien?
So
that makes sense? I mean, I know I would ethically, but
correct. Yeah.
but why would somebody pay that off?
Our
And we would
contract
want it
would
that
probably
way.
be set up that we would pay off the first inside of an escrow kind of account in
Okay.
that contract with you guys. Hey, listen, I need a payoff balance at first. Make sure it's included in our contract. Would say this would happen, and we probably run it through like an escrow or attorney to ensure that money gets DV'd correctly.
Okay.
To be quasi closing, I kind of set up. That's how I would probably do it in that situation. I haven't done it yet, but that's my thought process.
Okay. So why would somebody only sell the second lien?
You can't
Why,
sell.
why
it
would
for-
somebody even buy just the second lien?
So.
Second lien holders are a little bit of a different, it's a different spin on the same thing that we're talking about. They have all kinds of reasons. Dave, go ahead. I don't do seconds.
Let's say you have a lot of loans were created with piggyback, right? 80-20 loans, right? You have $100,000 property, we can use $1 million property, whatever. The first one's like a 60, the other one's a 20, right? 20 grand, total 80 grand. So now you have up to 80 grand, $100,000 property. You have LTV at 80%, which is not the best, but fair. Now I can go and buy that second lien for 20 grand, or I could buy for 10 grand, say, right? And I can start receiving payments on that second.
Right.
I'm not as secure as the first, right? I can get, we won't get into all that stuff, but I can buy it. But the problem is, if that property drops in value, my second lien gets squeezed with equity.
But that'd be in a second lien smaller in a smaller second lien against the house versus a wraparound mortgage.
Correct. So in a
wraparound situation, we need to pay off the first lien.
Yes, because you say you have a $100,000 second, right? And a $40,000 first, technically, right? And the property's only worth, say, 90, you're up to 140.
Yeah.
I would need you to pay off that first for me to get in a position.
Right. Okay.
Right.
That's I guess that's where I got lost, because I
Yep.
was like, wait a minute, in a wrap situation, you got to pay off the first.
Yeah.
We
So
would
we're getting
certainly
a lot
prefer
of
that.
questions in the chat. I appreciate you guys. So again, we're in the numbers. If I sit there and bought, if you bought a 72 loan and you bought it for 40 grand, whatever the situation is, and the balance of that first lien is 40 grand. You then create a new note, save for 80 grand, whatever, 100 grand. I can come in, buy that $100,000 note for a discount, say 70,000, 75,000. You then would pay off the first for 40 grand. You would collect 35 in your pocket. Then our lien, because the fact that the other one's gone, moves up to first position, and now we're in first position of your new created note.
So would you buy that? Would you buy that as if it was a first position lien, or would you still buy it with the
But I
second
would
position
definitely
discount?
price it that way, yes.
Okay.
The
Okay.
risk level is less there because it's a first lien.
It will
And
be a
we'd-
first lien. Yeah. Okay.
Right. We'd have that understanding that the first is going to get paid off. So that would put us into first position.
Yes.
And Melissa, did you have a question on that too?
Well, I had a question based off of the fact that, let's say, like Justin said, we have a deal that has no equity, but then we created money with it.
Mhm.
We owner financed it. Let's say, the house is worth 100,000 and we sold it for 140,000, right?
Mhm.
You say you buy those. How do you buy those? Since you're not buying against the LTV, apparently.
We're basically buying based on returns.
Right.
Right.
We're gonna look at LTV as a factor, but we want to look the fact that we're buying a bond initially, right? It's a bond with a maturity date. And most of the time bonds are calculated by yield. So we're gonna say, what would our annual return be on this situation? We're gonna buy it based on that annual return. 10%, 12%, 8%, whatever the number is. And
Nice.
people calculate different things differently. So that's one of the factors is making sure your interest rate's a pretty good high number, because the lower the interest rate, the lower my discount has to be, or more my
Right.
discount has to be, right? So if you're creating notes at 12%, you're doing much better than someone creating 8%.
So,
Gotcha.
and going back to your thing with the equity, you know, if it's $140,000 note and the house is only worth 100, we're probably going to price that on the value of the house in that situation, because technically it's underwater, according to
Yes.
present value of the property. So we're not going to, you know, we're not going to play the game where we think that the price is going to go up on the value is going to go up on the house. I'm not saying that's a bad game to play. That's just not our game. We're going to do it on today's values, today's unpaid principal balance, today's property value, whatever it is right now.
Does that make sense?
No, because
Good.
if you're saying that you can sell a note that does not have any equity in it, so can you or can't you?
Yes.
You can,
Okay.
but the pricing is going to be based on the lower of the two. If the property value is lower than the unpaid balance, we're going to do the pricing based on the property value, and vice versa.
And what would that pricing look like?
It depends on the state.
Step 2.
Yeah, there's a lot of questions go into that. Sorry, someone asked how to ask questions in the chat. Feel free to put it in the chat. We'll definitely answer as we can. So pricing based on state for us, and we always price the fact that it may go non-performing. So that means I may have to foreclose on it. And different states have different regulations and rules and pricing on foreclosures. Where Texas is awesome, Missouri is great. Go up to Chicago, you're having more problems, right? Northeast is just disastrous. California, some of these states out here have a long foreclosure process, which means that I'm gonna have to hold that property and taxes, everything else longer. So my return is gonna be less. I also have debt license to worry about. So there's different things that go into the note side of buying things. And if you're looking to learn about the note side, feel free to reach out to us. We run a class on stuff about this stuff for note buyers. But you guys as sellers, you guys have to know the fact that every asset's a little bit different based on price of value of the house. If this is a $40,000 house or a $150,000 property, that changes my pricing.
Yeah.
Right?
Interest
Interest rate, my
rate.
pricing.
Yeah. Interest rate is a big deal. Which state it's in is a big deal.
So.
Seasoning plays a part. Down payment to some extent, like Dave
Yep.
says, about loan to value. So all those things kind of go in, and we've got a list of those kind of things.
Yes,
We'll
we're
get into
getting
that.
to it stuff, right?
Yeah.
So one of the things we want to make sure you guys know is that there's a thing called a legal balance too. I recently ran into a seller finance person that was going to sell me a note, and they said, here's the UPB, and we're trying to figure out how they came up with the unpaid balance currently. And what they did is included like property taxes they paid up. Well, what you have to find out is that that's a separate dollar amount, separate from the unpaid balance. The
Right.
unpaid balance follows the amortization schedule, like a T, and then anything extra, insurances, taxes, anything corporate advances is part of a legal balance. When you collect legal balance, you can make an arrangement with the borrower, or if it goes foreclosure, I can add it to my balance at the auction.
Mhm.
So make sure you have the unpaid balance there.
So and then
So-
the unpaid balance, that's, and Melissa, I don't want to pick on you, but just to point it out, that's the problem with apartments.com, is that it doesn't calculate principal and interest. All it's tracking is monthly payment, which is good. And we definitely want to know that number, but we also, because we have an amortization schedule to follow, we need to know how much principal and how much interest is being paid every month, which is where a servicer comes in.
So we're gonna
That's
get,
where
let me jump one thing before we get there.
Yeah.
Just
Yeah.
know the fact that please don't give us PITI. For those who don't know, principal, interest, tax, and insurance. All we care about is principal and interest. Why? Tax and insurances are something we don't receive as note buyers. I'm sure like you guys, we don't receive it. You guys may, and then it gets paid out, right? Our servicer typically does an escrow and then pays that money out. So we don't see that. All we care about is that principal interest, which does not change no matter what happens with taxes or the insurance part.
Right.
So all these kind of deals of numbers and making sure that you don't receive part payment or you pay, they receive more, and to make sure it applies correctly. Using different services are great. There are software out there to manage these things, right? However, like landlording, we have things called note servicers. Note servicers will reach out to the borrower. They'll send monthly statements to the borrower. They'll resolve issues with the borrower. They'll, if there's a defaulted loan, they'll reach out and try to negotiate with them. Try to save mods. They're a property manager in the note world. What they also do is provide a system of tracking the payments. Unlike apartments.com, where it's a rental system, servicer is actually meant for notes. They'll actually have a system where it shows you your payments and what they call a next due date. Like an amortization schedule, if they don't pay for 3 months, the next due date doesn't move until the next payment's made. So if they haven't paid in 2 years, the next payment gets applied 2 years prior. Okay, where rental apartments.com, if I say, give me a payment history, you guys will show me a payment history, but I don't know which one that applies to. And there hence the problem, especially if we get to foreclose on it.
And that's the thing. All of that information is important for us for our worst case scenario, which is for us is foreclosure. So we have to have all that information, has to be accurate and correct and up to date so that we can give it to the attorney so they can do the foreclosure. So that's a main focus for us as far as why it's important to track those payments the way that we'd like them to be tracked. And not even that we like, but we need them to be tracked that way so that we can prepare.
If the loan goes into bankruptcy, they're going to want to see the
bankruptcy,
right? If it goes to foreclosure, prove the actual balance of the loan. How do you prove it, right? Where payments are all over the place and stuff like that. So one thing, when we ask for our numbers, which we'll share, and we'll share your link to a form we can give you, they'll email you over the whole list of items, is we want to know that you can go to a servicer and get the dashboard. We have Sohal on here. He can explain a little bit if you have questions, where you can really take a picture of the dashboard and it'll tell you all the numbers that we would ask for, right? We'll also provide you monthly statements, notes from the borrower. So if they reach out to the borrower, all those notes are there. So the interactions, and all of us note buyers wouldn't want that information because it helps us know what the life of the loan is going on. So one of the questions we've had too is how much are note servicers?
Yeah.
Well,
so
what we don't ever get involved with, because most of our loans are bank originated, is you guys can put these in the note agreement. So
you can have the borrower pay for it, the renter.
Yeah. If that borrower pays for it, guess what? Our price will actually be higher. Because we don't got to net that out.
Pretty significantly higher too, I believe,
Yes.
right? I mean, it's a pretty hefty increase. I know when Dave and I talked about that note I had for sale, I mean, it increased the value of the note by like $3,000 or $4,000. It was like, oh wow!
Because for next 10 years, I'm not paying a servicing fee. I'm collecting the whole P&I amount.
Right.
I mean, luckily for me, we were kind of taught to, when we use our servicer, to put that in the agreement that the servicer pays, or the borrower pays the servicer.
And that servicing fee can be a significant portion of that payment. Sometimes yes, sometimes not. Usually it's a flat fee. So let's have Sohail chime in here.
Yeah.
Maybe you don't want to get into pricing. I don't know, but
which question? There he is. Let me flip it over here. Oh, sorry guys. There we go. Flip over my system over here. So Sohal, welcome. I appreciate you being part of it. I do want to ask you a question about this pricing thing. We would like to know from you, how much does it cost for a note originator to charge for the fee for a monthly servicing for a performing note with HomeKey?
So with us, with HomeKey, we have an all-inclusive monthly fee, which is $35. That includes collecting the payment, managing the escrows, taking care of the tax statements at the end of the year. If there is an underlying lien that you need us to manage for you, we will also do that at the same price. There's no additional cost. It's $35 flat fee. We do charge a $100 setup fee, which goes to our service provider for tax certifications and things like that. But $35 is all we charge. And there are servicers out there who may charge a little bit less, who may charge a little bit more, but then it's not an all-inclusive fee. They tend to be more a la carte. The more services you use, the more you pay. The fewer services you use, the amount is a little bit less. In our case, it's all inclusive.
Yeah. So we did a question real quick about what information we need as note buyers to buy. I put in the chat a link for a form, fill it out, and you'll get an email with all the data points. We're going to get into in a few minutes what information we need as note buyers from you guys. Cool. So guys, this stuff is really cool stuff, right? And you can use a servicer like HomeKey to set up a situation where you literally can send us the payment history, servicing notes. You can send everything we need, all the data points to get to. But before you get to that, I want to make sure you guys figure one thing out. Please make sure that you're understanding that if you're selling a note that you into it for 40 grand and we price it 50, understand that 10 grand may not be a big amount, but if you can do that 4 times in 1 year, that snippet of the return is amazing, right? So you've got to make sure that your price, when you see an offer from us, calculate that as an annual return versus a one-time lump sum ROI. Because that will dramatically increase your returns no matter what you do. And you could do this, if you could do this 4 times a year, season it for 2 months, sell it to us, season it, sell it over and over again, that 10 grand on 40 multiplies.
And yes, we're more than happy to buy notes from you all through the year, any day.
Twice on Sunday.
I tell you guys a funny thing about the servicer. I was, because I've always used a servicer and I didn't know that there was any other way. I had no idea how much my borrowers actually paying. I didn't even know that they were paying for the servicing. I know we originally put it in there, but I had to actually reach out to Sohail because he services my notes. And I got one of their statements and I was like, oh, well, this makes sense. I was worried about taxes and all this other stuff. And all that stuff was just taken care of by Sohail and just made it so much easier. And again, the borrower paid for it.
Hey, there you go. Excellent.
Nice.
So just looking at some of the questions we got here, what states that servicers cover? Understand the fact that you're right, servicers are technically licensed in certain states and don't need license in other states. Every servicer is a little different. Some servicers are not in all 50 states, but you may not need all 50 states. If you're originating notes only in Texas, that's all you care about, right? I know Justin uses Sohail and HomeKey. If you're originating in Texas, just call HomeKey and they can do it. I know Sohail is working on adding additional licenses on, but yes. So yes, states for servicers matter. So I know we had another question from Michelle about servicing services. I would say that your services from your servicer is more about tracking the note, right? They're not going to do they can sign up for door knocks, stuff like that, but they're really just your property manager to collect and deal with issues.
I would have them do have them do more than less. They're set up to handle all kinds of stuff, but you're right, Dave. Mostly it's taking care of the payments and everything surrounding the payments. That's the servicer's main job.
So right now you guys are in Texas. Are you guys looking to get licensed in a few more states as well?
Yes, we're awaiting licensing in Georgia, Tennessee, Ohio, and then in January we'll apply for Florida as well. Additionally, we will enter Virginia, Colorado, and Indiana in February as well.
Awesome.
Well,
And
you're
Sohail is
dancing
very
all around
familiar.
North Carolina. So what is the problem with North Carolina?
I am not a big fan of North Carolina yet. They are a little bit strict. Their audit requirements, from what I've heard from other servicers, do tend to be a little bit challenging. And what's worse is The audits do happen every 2 years at a minimum, and their auditor prefers to come down over to your home office, sit there and audit the books versus just doing it from North Carolina itself, because all our records are online anyway, and we have to pay for their expenses, their flight, their hotel, their food, things like that.
Goodness.
Yeah.
But we do know other servicing companies that cover North Carolina, South Carolina.
Yes.
Oh, perfect.
There's some really good servicers that do cover those states.
Yeah. We'll be happy to help you.
Yeah, I have a list of them on my due diligence portal.jkpholdings.com/servicers. You can find it there, the list. But I want to make sure that you know that Sohal really work with owner finance investors. He understands your world. That's why we brought him on. We work with a lot of servicers. A lot of them will get the paperwork from these kind of people and actually push them away because it's not as clean cut as Bank of America. Right? That makes sense for everyone.
It looks a little different. It's paperwork is a little bit different, and they just want quick and easy.
Yeah.
Then there's other ones that'll dig in and look at the actual documents individually, because that often is what it takes.
So Hal, feel free to put in the Facebook chat, also your website too, if you want. I know you're on there as well. Alex asked a question. Any issues buying a note that's in first that has a second, third, or anything else behind it? Are there discounts that come with that? Do you even care about the supported notes? Straight answer, don't.
Not really.
The only time that comes to play is if we go to foreclosure, right? And it actually comes to sale, their notes are going to get paid, but we're going to get paid off as well, right? We're going to get our unpaid balance, say it's 60 grand, we foreclose on it, we're going to get our 60. We can't collect anything above our unpaid balance or legal balance, sorry. We can't collect, if it sells for 100, we can't collect the equity on that, right? If it reverts back to us, we get the equity, but we don't get the equity or any proceeds above our legal balance because we're not entitled to that money. So these answers, no.
No, don't care. The things that we would care about is outstanding taxes or municipal liens, things like that. Those place above a first lien in order of priority. So those things affect our bottom line. So yes, we care about those things, but any subordinate liens, seconds, thirds, whatever, no, doesn't really make a difference. Man,
All
there's
right.
so much more to cover.
Yes, this is great. I love the conversation you guys are having. I love the fact you guys are asking a lot of questions because this is a field I've talked with Justin numerous times and he's still learning what we're talking about at the time because it's a new world of stuff. And we're looking to do a webinar and hopefully you guys all stay tuned. We do webinars every other week, but we've primarily been focused on note buyers and teaching them stuff. So we wanted to, we're working on getting a webinar on there about how to create a note, a successful note to make sure you're licensed correctly. And that's why we'll bring on Max and stuff like that to talk about what you can and can't do, such as the Dodd-Frank laws, right? You can't write a note to an owner occupied property without certain restrictions there. Things like that will come into play. And we'll talk more about that stuff on the upcoming adventures.
Just out of curiosity, Justin, Melissa, have you heard of Dodd-Frank? Do you know what that is? Okay.
Yeah.
Okay, just checking.
Yeah,
I've heard
of course.
of him, I've heard of it.
Okay.
But I get that it has its place. Yeah.
All right.
The biggest thing for me is my understanding is the limitations of how many notes that we can create, that we can originate without having an originator's license.
Right.
So Dodd-Frank is a very big legal document, and there's things that we don't fully understand either.
That's part of it. Max is the expert. I always defer to him when I've got questions. I'll call him and say, "Hey, can I do this?"
That's the main reason I even use an RMLO and an attorney. Just say, "Hey, here, make sure I'm good."
Yeah.
Right.
Max, if you can chime in real quick, what do you guys charge for underwriting a note to make sure it's Dodd-Frank compliant?
Yeah, great question, Dave. Standard underwrite is $679, and that's a bona fide fee that can be passed on to your borrower, but your borrower can't pay it before being offered a loan. And so one of the lending laws, Fair Credit Reporting Act and Equal Credit Opportunity Act, so FACRA and ECOA, state that you're not allowed to charge anything to a borrower prior to offering them a loan, except for the only fee that's transferable to a borrower up front is a credit report fee. And in our case, we pull the credit for you, so you can't even charge that to your borrower. So a standard Dodd-Frank underwrite is $679. We invoice you in two pieces. We invoice you $119 up front, and then we get with your borrower and we gather all of the documents necessary for a file. We work the file all the way to completion. And then if we can get your borrower to meet Dodd-Frank requirements and certify them, then we would invoice you the final $560 at loan approval. So on the loan estimate, or the old HUD one, if you're familiar with old style lending, that loan estimate, you as the lender have to disclose all of the costs of credit to your borrower. And so that $679 underwriting fee would be added onto your borrower's column as one of their loan origination expenses. So you would front us the $119, we'd get your borrower qualified, and then at closing, that other $560 would actually basically the entire $679 would be a borrower's closing cost. So you can recoup that cost at the closing table.
Nice.
Awesome.
And
Thank you
I
very
know
much.
Max has been extremely helpful for me
Yeah.
when I'm doing some originations, and like I said, I've gone to him with questions. Can I do this? Is that okay? And he'll let me
Yes.
know, yay or nay. But
And just a
very
quick
valuable resource.
side
Yeah.
note too, Nathan, for anybody that doesn't know, we don't just underwrite for Dodd-Frank. So I do a lot of commercial work and a lot of non-owner occupied work. And so if you're ever in question as to why would you want to underwrite something if the law doesn't make you, I could have a discussion with you and give you a lot of good reasons why. Just in a nutshell, though, a couple of the big ones would be, like, for instance, we have an investor in New York that buys a lot of apartment buildings and basically flips them and resells them to other investors. They can be speculative ventures. We underwrite his borrowers to his standard. That's the beauty of non-owner occupied, is then Dodd-Frank is out of the picture, CFPB is out of the picture, and you and I sit down together as an investment team, and we set the criteria that you want us to underwrite your borrower by. And so what we're doing is we're ensuring your best interest from a risk of default standpoint. The other thing that it's doing is it's creating a consistent due diligence file for your ventures. And then when you want to go and resell those notes to somebody like Nathan and David, we've got files that you can present to those note buyers that demonstrate the professional consistency with which all of your borrowers are vetted. And that can bring a lot of value to your note.
Awesome.
So Max, so for those who don't know, Max is Coley Underwriter. You can go to coleyunderwriter.com. He can talk about all this stuff in much more detail than we can. I know Michelle's asking about that. Sydney, thank you for jumping in there. I appreciate that. So all that good stuff.
Thanks, Cindy. Michelle, just wanted to come back to your question about, so you actually act like refinancing? Yes.
Yes.
Yes, we want to refinance you so you can go out and buy, create more notes and then sell them to us again and again and again.
Yep.
Take whatever profit. We don't care.
Yes.
We want you to make a profit. We're in it for a different reason. So we're more than happy to have you make a profit off of us, selling it to us, and then you go out and do it again and again and again. And we'll buy those all day long.
Yep. So what makes it a valuable note? We won't get into the legal side of it, but understand the fact that for us, we have performing and non-performing assets, and those need certain data points to figure these things out. We're going to go through them quickly here, but Again, in the chat, there's a whole, click the form link, click on it. You actually go to a form, fill it out real quick for us. Phone number is not required, but that will actually send you an email out directly from jkpholdings.com. If you don't get it, reach out to us and we'll go from there. But what they'll do is it give you a link to either PDF or spreadsheet that you guys can get and actually just fill it out and send it to us if you want to. Make it nice and easy for you. So what do we need? And what do we not need? Let's start with what we don't need. It's comical because in the last couple weeks, we've seen a lot of notes from seller clients coming up to this webinar. I don't need to know what kind of fridge is in the kitchen.
Yeah.
Don't care. I don't care what rehab you did. I don't care the borrower was a locksmith and his grandmother was the mayor. I don't care. Credit score. Oddly enough, I don't care.
We actually care very little about the borrower themselves.
Yep. Because Max or someone else underwrit the paper that it's legal and it's foreclosable. We want to make sure that the collateral is foreclosable. So our attorneys will review it as well, make sure it's foreclosable, legal paper. Because performing assets great, doesn't matter if it performs forever. It matters if it defaults. That's when the paperwork kicks in. So if you have questions, again, feel free to put in comments or send us an email and you'll get that. We also have lien position matters. Why? We talked before about the fact that first, second, third, fourth, we can buy a fourth lien, but understand we're going to buy a significant discount because if it goes to foreclosure and there's not enough money to pay it, we get wiped out. It can happen. Original balance is another item we require. We need to know what the original balance, not what you sold it for, but what the original balance was of the note created.
So after the down payment, what was that amount that you are financing? The amount that you're actually financing?
Yep. Term. What was the original term of the note? Was it 10 years, 120 months? Was it 360 months? Right? What was that term? When was the first payment date? What that helps us do is figure out when the maturity date is going to be. Right? If you originate this date, usually a month and a half later, or whatever it is, we need to know when the first payment was made.
And going back to term, we deal in number of months. So we talk about 240 months or 360 months or something like that. If you just have it in years, that's fine, as long as it's like a round number. So if it's 18 years, that's fine. We'll figure out how many months that is.
But if it's 18 years and 6 months, we
Right.
need to know that.
We need to know that too.
Right.
Would it not be easier to just give you the maturity date?
So yes.
That too.
Yes. So there's ways to figure out how many months the term is by using formulas and financial calculators. We can, right? And if you're not able to do it, let us know. We can either figure it out for you, or there's different ways to figure out the other numbers through math, through a financial calculator, or through spreadsheet numbers to figure out what that number is. But if you have it, which should be on the note, the term should be on the note, first payment, number of payments, maturity date, and a balloon amount, which we'll get to, right? We need to know the balloon and how much that balloon is for, because if it balloons at a certain date, a certain dollar amount, that changes the monthly payment and the numbers in between. And
we are going to ask for maturity date as well. It helps us just to make sure it's accurate.
Yes.
That there wasn't a mistake where it's 1 month, one way or the
or
other.
a modification happens.
Something like that.
And
Or a
they-
modification.
Let me ask you, maybe this is a question for Max, but like in a situation where we create a note that's amortized for 30 years, but there's a balloon at 10 years. I mean, I've never even done that for the reason of, I thought it was more beneficial to put it out for 360 months.
Sure.
It
Yeah.
helps the balance.
Go ahead, Max.
Yeah. The biggest issue is there's certain risky features that are prohibited in Dodd-Frank. And then there's other features that you can do them with limitations. If this, then you can do this, but if this, you can't do this. So typically in Dodd-Frank, so we're talking owner occupied 1 to 4 family, you're allowed to balloon after the 60th month. So if you do want to do balloons, just kind of try to think about it this way. The entire spirit, intent, and flavor of Dodd-Frank is to prevent home owners, right, families from being displaced and creating another 2007 housing bubble burst. So when we talk about putting somebody into a brand new home, you can't put them in a home that next year, all of a sudden, if they can't refi it, they're looking at being foreclosed on and losing their home. And so the federal government requires a certain standard of consistency and predictability with respect to how soon do the terms of this agreement change. And so for Dodd-Frank, 1 to 4 family occupancy, think about keeping them in there for 5 years, typically.
I actually prefer no balloon. It's if nothing else, it's easier math.
Yep.
In general, I prefer not having a balloon. Dave, do you care?
No, I mean, it's a math equation for us.
Yeah.
But it pretty much doesn't matter to me because most likely we're not going to get there most of the time. Understand most loans don't last 30 years. They just either paid off or something happens to the house, they sell it. So, something always happens. Most people don't hold a house for 30 years. So I'm not too worried about that.
Just so you guys know too, when we underwrite for you, we can always produce an amortization table for you and give that to you right off the bat. So if you're working with Nathan and Dave, that gives you kind of that opportunity to start looking at that thing ahead of time and get a read on what it's going to look like.
Mm-hmm.
Yeah, awesome.
Yeah, perfect.
Question about the form. Feel free to hit the form. It's a brand new form we have. We put it out yesterday. And a caveat, I did have this private message sent to me. No, Nathan and I are 2 different companies. We're just good friends. So we would make 2 different offers to you. That's why we're cooperative, but we're also competitive, right? So, so another thing we mentioned here is that you make sure to give us the P&I, not the PITI. We need tax insurance. You can make it a different row, but just the P&I is what we need. At interest rate, that's a definite thing we need. It allows us to figure out if the payments make sense. It also tells us the loan. If you present me a loan that's a 3% coupon rate, either A, I'm not going to bid on it, or B, if you need me to bid on it, my price would be dramatically discount compared to the balance of loan. Because for me to get a 3% coupon up to say an 8, 9, 10, 12, 14, whatever I'm shooting for, I'm going to give you a significantly lower payment.
So
Most people out there are looking for a bunch of money and they don't care. But understand the fact that for me to buy a $40,000 note at 2%, it must be a much higher UPB, much higher.
Yeah. So general advice, write it at a high interest rate without going over usury laws.
Yes.
And usury laws are specific to every state. So check that out for whatever state you're in. But as high as you can is great. And that helps us. That helps you get the most money when you're selling it to us. Let's put it that way.
What about taxes and insurance being escrowed? Does that affect the value at all?
Nope.
No.
So if it's not escrowed and you rely on the borrower to make that payment at the end of the year every year, that doesn't affect your risk at all. Okay.
It doesn't. It should, but it doesn't technically. If the borrower doesn't pay it, I have to pay it anyway. And if they default, I'm going to pay anyway. Right.
Okay.
I can ask them to pay it in escrow. I can always talk to my servicer and get it escrowed if they want to. I can do a mod, but no, it won't affect my pricing now.
One quick point also, when you're talking about trying to get your borrowers qualified, we're talking about debt to income ratio and state specific residual income. Just bear in mind that while you can write a term of almost any number of months you want, it's all usually in your and the buyer's best interest to draw a longer amortization period because as David or one of them mentioned anyway, most of these transactions won't last throughout the term of the amortization anyway. But what it does for their P&I is dramatic in terms of meeting debt to income ratio. So I have a lot of folks send me term sheets, and they'll send me a term sheet with maybe, let's say, 180-month term. And then when we calculate debt to income ratio, these people are over DTI. And simply by getting a hold of the investor and saying, if you'll bump that to 240 or 360, we can save this deal for you. So don't get wrapped around the axle with the idea that, I need the P&I to amortize in 180 months or bust, because a lot of times that will bust. But I don't think, and these guys can correct me if I'm wrong, but from their standpoint, 360-month term isn't going to hurt your value at all, but it's going to bring in a lot broader category of borrowers who can meet that requirement.
Absolutely.
Yep.
Right.
Yeah, a 30-year is pretty typical.
Yeah, absolutely. We just price everything according to an annual return.
Yeah.
So yes, you're going to get a different price if there's 20 years left, but it's just a different risk level and return level. So next one we need to know is your type of property. Please let us know if it's land, if it's a mobile home, if it's a condo. What we don't buy is I don't buy land notes. Nathan, do you buy land notes?
I don't know.
Okay. I don't buy things in mobile homes typically. I know a couple of the owner finance people have been mentioning it. There's a little bit different type of note that I'm not familiar with as much as typical real estate and commercial. So that's a little bit different for me.
Same. I don't love mobile homes. I'd look at it, but it would have to be special.
So
When you say,
yeah,
quick question, when you say mobile homes with land or in the park?
Exactly. That's the problem.
yeah. Right. So yeah, mobile homes could be land included. It can be a mobile home with rented land. It becomes a little bit fishy for us, which we don't get to. One question we had is what kind of note documents you need from us? We're going to assume you're the originator, so we won't get into the other note craziness. If you're buying and selling a note to us, we'll need more documents. But typically we just need the mortgage, the note, and for those who are not aware, make sure you get a title policy. Title policy ensures the fact that there's no liens and it's clear title. If you don't, go get one. That makes it more attractive to us. Make sure there's no additional liens prior to the sale of the property.
And it doesn't cost a lot. It's well worth it.
So all right. So I have an interesting question. So I bought a house subject to that was owner financed. And I ended up having to refinance it because the daughter came in. Long story short, I ended up having to refinance it with a bank. I almost wonder if I should have just bought that note from her. But if I bought that note from her, how would that affect me selling it later?
Not at all. You can resell it. Yeah, I mean, you could broker it out if you wanted to.
Yeah.
You don't even have to own it yourself. You could sell it to us.
Interesting.
So
and then could I still own that subject to?
Yeah.
Because that one got really interesting really fast. I ended up offering her, I think we owed like 65 and I offered her 50 and she ended up taking it, which ended up being beneficial for us. So we ended up doing a cash out. But looking back on it, I'm like, well, maybe we should have just bought the note from her and then sold it. And then, I don't know.
Yeah.
You could do that.
But that makes more sense to me.
Yeah, we won't get into it, but basically what you need then is an assignment of that, just like you guys do assignments, but we see an assignment of the mortgage, and then you have the allonge, which attached to the note. That would just transfer from one seller to the next. And if we buy the note from you, we'd be creating that same paperwork. You're selling to us, and you transfer the note transfer from your name to our name, and it's a paper process. And then we record with the county records. So it's official that the lien transferred over from you to us.
Very easy process. There's just really not a whole lot involved with that. So, yeah.
So as we go down the line, we need the property address, street address, city, the state, and zip code. It allows us to figure out how much the property is worth, so we can figure out these kind of numbers. Maturity date we mentioned before. The current unpaid principal balance, which is the balance of the loan as you move along. Again, if you're using apartments.com, this will be much more difficult to figure out. Recommend moving to a servicer or buying a servicing software and figuring it out and apply payments as per se. Then we
That
also
being
need to know,
said,
yeah.
Yeah, if you've got something that you've only ever had with apartments.com and they're, especially if they've been totally regular and same amount every month, send that along. We can do the math on it. It's a little bit trickier, but we can do it.
Yeah.
So if you've got something that, oh shoot, I'm screwed. No, not necessarily.
Give us a shot.
Send it along. Yep.
Let us know. Maturity date, current unpaid balance, next due date. And we explained before, the next due date is next date in part of the amortization schedule, not the last payment received. It's based on the amortization schedule. Most time, if it's performing, the next due date's next month. Last payment received, that is just telling us when you get to receive that payment. It could be yesterday, it could be today. It's ideas. And last two is a balloon. If there's a balloon, we just need to know how much the balloon is and the date of the balloon. It helps us figure out the numbers for us and things like that. The last one is modification. More than likely, you guys have never touched modifications, but if the loan is modified, we need to know the date of it and what that new terms are. Interest rate and balance, all that good stuff. If you didn't change interest rate, that's fine, but all that good stuff is there.
That's
Lots of
Question
stuff.
about
That's
equity.
what we need.
Go for it.
Again, you and I, Dave, have talked,
Yes.
extensively about equity, and you're not as concerned with equity as I was. I thought that equity and interest rate were like the biggest things that we needed to look at here. I had a note that had a ton of equity, but that really didn't affect the price of the note.
No,
And why that
it's-
is, I'm still trying to wrap my head around. I understand that if it goes to foreclosure, you're only entitled to what the, but does the equity reach a certain point where it stops making as much, stops being as much affecting the value of the note?
Give us numbers. Give us an example if you can.
Okay, so I had $150,000 house that I had a note on it for $65,000.
Mhm.
That note was worth $55,000, essentially. So I had, $80,000 in equity. The borrower has $80,000 in equity.
Yeah, there's the key.
right.
But in a situation where the borrower only had, like, say, $20,000 in equity, that wouldn't affect the purchase price, how much you would pay for that note.
I would say this, LTV, loan to value, affects if I'm going to buy it or not. If you're looking at the fact that my loan to value is 90%, I'm going to probably pass on it because of the risk of what's going on in the market. It doesn't affect me with my numbers, because if you're saying $85,000 in equity, I have to foreclose on it, which is stupid for the borrower to have to get foreclosed on a property of equity. When you do that, I go to the auction, I can only collect up to that balance. So even if they have 20%, I still can't get the other 20%. I can collect
Right.
up to that legal balance, unpaid balance plus corporate advances. I can only collect up to the legal balance. Now, if it's flipped upside down, right, the property worth 50 and the unpaid balance worth 100, we're gonna be bidding based on that value of 50,000. You're not gonna get much because there's no equity. I'm gonna be bidding 40,000, 30,000. And you say, well, there's a lot of unpaid balance here. Well, I can't buy it because if I go to foreclosure, I'm not gonna get that money back. That property is not worth that much money. The collateral.
And an investor is probably going to buy that. But if there's, and like you said, you'd pass up on it if there was only $20,000 in equity. Because
Percentage
if it
wise,
did go, right, okay,
right?
yeah.
If you're looking at, a property that's worth 40, and it was worth 60 and it's for 40, that's a different number than it's worth, 130 and you have 110 note.
So investors like to buy at 75%. So as long as we're sitting around that 75% mark, we
Yeah,
feel
that's-
pretty comfortable about
Yeah,
selling.
that number's moving as we go along here with the
Correct,
market, right?
right.
What we said in the last webinar we had, me and Nathan, when we first got started, we didn't look at equity back in 2010 because there was none.
There's never
Right.
ever equity.
Right?
Ever.
Everything was underwater.
Yeah.
So for us to now play with LTV, it's kind of a new thing for us because nothing had loan to value.
And that's only been true since probably 2018.
Yes.
That's probably the first time that I saw any equity in any loan that I looked at. And I'm like, oh, shoot, what do I do with that? And we had to actually kind of invent and figure out what we're going to do when they did have equity. So the
No wonder
negative
why
equity
that's-
does not scare us at all.
No.
But just understand we're pricing it on the lower of the two. Either
Yes.
if it's underwater, we're going to base our bid on property value. If there's a lot of equity, we're going to base our bid on the unpaid balance.
So on like Melissa's example, where she has $100,000 house, the borrower borrowed 140,000, you would probably pay only $60,000 or $70,000 for that note.
If the house is worth 100,
Right.
we'd base it off the $100,000.
Okay.
Yeah, absolutely.
Okay.
Yeah, there's more numbers, but yes, that's.
Of course. Yeah. I'm just trying to be as round as possible.
Yeah. Yeah.
Okay. Okay.
This has
That
been.
makes sense.
Again, I put in the chat, what the link is for the form that you can fill out. If you have assets you're looking to sell, if you have stuff, feel free to use that, fill it out, send it back to us. We did cover most of the stuff in that list. If we have to change anything or update anything, we will let you guys know. But we think this was helpful. If you feel this was helpful and you would like us to do a webinar on how to create a successful note, what would make it more valuable, let us know. We'll work on something for January to make sure you guys can include in that. If you're looking to learn about note buying and understanding our world, reach out to. We have webinars and videos, and we also have a intense advanced course. We're starting back up on January 3rd. It's a huge course about how to buy notes, numbers, figuring out things, what's important, all the systems, all that good stuff.
Dave, can I ask another quick question?
Please.
And this is something that I kind of had saved up. I wanted, and I think you just answered it, but I was wondering about how the market's going to affect like the values of our notes. Is it going to affect them
Listen,
the
you're not allowed
same
to
way
ask that
that
question.
that's kind of been my biggest question lately is how that, and I guess it's just affecting the values of the houses at this point, and then you buy based on the values of the houses.
Yeah. So that's why the LTV comes into play a little bit here, because if we're 75 or 60 or 65, whatever the number we figure in our head, if it juts down, we know the fact we have some buffer room. But yeah, that's when it plays in part. But the reason we say you can't ask the question is that's our question for you guys. And maybe you guys are new to our webinars and all that stuff, and those who are still on our Facebook Live. We want to ask you guys a question. Go ahead, Nathan.
Yeah, where do you guys see it? So we've got our world, right, where we're predicting things coming in the future. From the seller finance world, how do you guys see it? Where is it going?
For me, I see it as an advantage, because if banks are going to quit lending, we'll continue to lend, and I'm sure Melissa can attest to this, where banks aren't lending to a lot of people, we can lend to them. And we can dang near name our price at that point.
Melissa, what do you think? Where do you see the house market going right now in your world? You see values dropping, staying flat? What are you seeing?
Well, that depends, right? Because I own houses all over North Carolina. There's some where the values are going down. But there are some where the values are still the same as they were. For example, if like my house is at the beach, right? They're not dropping in value.
Mm-hmm.
My house is where I live, like in Hickory, North Carolina. Yeah, they're dropping in value, but they're dropping in value at the same rate they do every time this year.
Gotcha.
So I don't really feel like we're going to know what's going on with this market until like March of next year, where we have a full year to look and see what's happened from last year to this year. Because right now, the values are the same as they would be 3 years ago in December, because they always drop about 20% from late September to February. Right. Then comes springtime, when everybody starts looking for houses and sun is shining and weather is warm, then the values start going back up again. So yeah, all of that being said.
Yeah,
Interesting.
we'd like to hear from outsiders what they see the market of real estate going in the crystal ball, 6 months to a year. None of us really know, but we'd like to play that world of that crystal ball idea. But what we really appreciate you guys having your strength of knowing origination in this world of creating dollars magically in thin air. We were trying to bridge the gap between you guys originating and us buying and making that marriage happen smoothly so you guys can go ahead and buy more, sell more, buy more, create more. We can talk about parcels, you can sell par payments, but you can also sell a whole loan and it's more attractive for us. So
Well,
Eight.
great. I need some money and I have a whole list of notes that you guys can.
Excellent.
it's easy like that, right? You literally can sit there and sell us the entire note and get money out, or not that it's always the most attractive, but you literally can sell us a part of the payment stream next 5 years, 6 years, 10 years, and keep the back end. That's
Hey,
also available.
David,
So what-
let me ask you guys a
Yeah.
question, and then sort of get a gauge on from your perspective how the correlation to the Fannie Freddie rates and what note originators can make a rate at, how that's going to affect things. So for example, when the APORs were 2.78, we were creating notes consistently at 8, 9. So, we were a little more than a 6-point spread over, and it was very easy to do. And borrowers still could meet DTI and residual income at 8%, 8.5%. Now that the APORs in the conventional market are in the 7s or approaching 7s, to get that same kind of spread now, you'd be looking at HCM loans with rates of around 15, which is next to impossible to get. We're getting them in trailers, but we're not really getting them in stick-built homes. And the percentage of seller financed borrowers that can meet debt to income ratio and residual income at a 15% APR is much lower. So if that trend continues with Fannie and Freddie keeping conventional rates that high, how do you guys see that affecting us all in note creation and then on your end on note buying?
So for me, we have a certain return we have to get, right? And that return is now increasing based the fact that money is a lot more expensive. So for me, my desired return increases. It used to be here, now I'm up here. So my price is gonna change. That's my quick and easy answer for it. Nathan?
Yeah. It'll be interesting to see what happens here. Interest rates, inflation, all kinds of things going on in the world. As it makes it more difficult for people to get loans, people like the seller finance crew, they fill a major role. We're at the same time, we're also filling a secondary role. We're more than happy to buy the notes that are coming from the seller finance. At the same time, we're also more than happy to buy the non-performers. So if and when people start defaulting on their loans, those are also very attractive to us. That's both Dave and I, that's our roots, and that's our major thing. So I don't know what kind of pressure is going to be put on to people in general, and where does it all end, and when does it begin? Good question. I don't know, but it's looking interesting.
We did a question on Facebook, and I'm presuming you guys are okay with this. If you're not, let me know. Some of the people want to have your contact information. I will provide emails only. Are you guys, Melissa, Justin, you guys okay with it? I know Sohal's okay with it. For those who are looking to learn, may reach out to you for some education, all that good stuff. If you're okay with it, I'll share your email addresses. To those who just complete the form, I'll do a quick reply on form responses, and you'll get their information.
Awesome.
I
Well,
put
guys-
mine in there too, because I know, Dave, you got yours on there, but I don't think mine is actually on your site.
Oh, yeah, we forgot that part of it, right? We checked it last night, make sure the form response was adequate. We totally forgot to add Nathan on there. It's in there, but I'll fix the other form as well. I'll make sure, and Nathan gets the responses, the emails for the form as well, so he'll get the email responses and he
Yeah.
can reply to any questions you've got. Justin, Melissa, Sahil, Max, thank you very much for joining us. We're going to cut off the
Yeah.
live feed in a second,
Thanks,
but
guys.
stay on for a few minutes before we
Thank you so much.
disconnect. Max, I appreciate it. Your information will be also out there, guys. If you're looking for a servicer to get your things right, reach out to Home Key. If you're looking for someone to underwrite your loans, make sure you reach out to Max, call the underwriter, and he'll make sure everything happens on the up and up. If you have
We'll do
questions,
another one of these. We'll do kind of a follow-up one in January. More about, I think we're going to do more on the origination side.
yeah,
And
how to make it more attractive, how to make
Yeah.
it legal, making
Yeah.
sure that we have all the stuff needed. So
how to write that so that you can sell it to us at the selling table if you want.
Cool.
awesome.
Great stuff, guys. Thank you.
Hey, thanks.
Thank you.
All right.